Hello and welcome to Stockwatch Live. Budget airlines and utilities are in the spotlight this week as the topic of cost-conscious consumers dominates. Holidaymakers certainly like a bargain when it comes to flying, judging by the latest figures from Ryanair. The budget airline group, which is due to post full-year results on Monday, said it carried 9% more passengers in April than the same time last year, and that came in above the 6% year-on-year increase it saw in passenger numbers in March. The world really does seem to be its oyster for Ryanair, which will be able to tick 36 locations off the map when it starts flying to and from 2 airports in Ukraine from October. That will follow hot on the heels of Berlin and Dusseldorf, which will also start flying from this summer. Investors will no doubt be keen to hear where's next for Ryanair, and also more on its plan to develop Laudamotion, an Austrian airline based in Vienna. The deal is a tie-up with former Formula One driver Niki Lauda. Himself an old hand in the aviation industry, having started, run and sold on a couple of successful airline companies alongside his F1 career. Lauda will chair the low-cost carrier and oversee strategy implementation. Ryanair will provide financial and management support and take an initial 24.9% stake in Laudamotion, rising to 75% as soon as possible, but subject to EU competition regulatory approval. As part of the deal, Ryanair will also provide 6 aircraft, complete with crew, to enable Laudamotion to complete a 21 aircraft flying programme, and there are plans to shortly start a range of scheduled and charter services from Germany, Austria and Switzerland, primarily to Mediterranean leisure destinations. Pre-tax profits at Ryanair in the 3 months to December rose to €106 million, up from €95 million in the same period a year earlier. A fall in ticket prices, which came in 4% lower at an average of €32 a customer, was offset by a rise in passenger numbers, the airline said. Profits of between €1.4 billion and €1.45 billion have been pencilled in for the full year. On Thursday, it's the turn of rival budget carrier WIZZ AIR HOLDINGS, which is also seeing a take-off in passenger demand. It said it carried 25% more passengers in March year-on-year as it added new routes to and from Austria. And the battle for passengers is only likely to hot up as Wizz spreads its wings, and perhaps a little too close to comfort for rivals Ryanair and EasyJet. WIZZ Air UK, its wholly owned UK subsidiary, has just been granted an operating licence by the Civil Aviation Authority and began flying out of London Luton earlier this month. Now the 8th largest airline group operating in the UK, with flights to 74 destinations in 23 countries from 9 UK airports, the group will have almost 9 million seats on sale on its low-fare routes to and from the UK in 2018, representing around 14% growth year-on-year. Ratings agencies Moody's and Fitch have both initiated coverage of the company with an investment grade rating, which will not only enable Wizz Air to access new sources of aircraft financing, but also at lower cost. Broker Exane BNP Paribas is neutral and has a price target of £33 on the shares. When it comes to passenger numbers though, rival EasyJet can probably relax, having achieved its milestone of 36.8 million customers and seen its shares hit a 2-year high on the back of its latest results. What investors will be listening out for now is news of its EasyHotels business. Half-year results due on Wednesday will show whether it too is flying high. EasyHotel has already said it continued to significantly outperform the budget market over the 6 months to the end of March, boosted by EasyHotel's new booking engine and continued expansion of its network of hotels in key UK and European destinations. And that expansion is set to continue, with £50 million earmarked for just that, including its second hotel in Spain. Investors will be keen to know more, especially in light of the group's nod towards the cautious UK market and its own ambitions to buck any downward trend with its super budget branded hotels. At the start of this year, the group said performance since the financial start to the end of September 2017 was in line with the board's expectations, and that its owned hotels have continued to significantly outperform both direct competition and the wider UK hotel market. When it comes to talk of price and value for money, utility companies are only going to continue to feel the heat, and we have a plethora of company announcements from the sector coming up. As well as water company SEVERN TRENT, both SSE and Pennon Group are due to post results on Friday, and prices are again likely to be under the microscope. According to the Competition and Markets Authority, the planned merger between SSE and npower could result in higher energy prices, which isn't going to go down well with customers. The CMA said the rivalry between large energy companies was an important factor in how they set tariffs, and that the removal of competition could only lead to higher prices for some customers. It said the deal would face an in-depth inquiry unless the two companies could address the competition concerns. When SSE reports full-year results on Friday, investors will no doubt want more reassurance from Alistair Phillips-Davies, Chief Executive at SSE, that anti-competition fears won't hamper the deal. Morgan Stanley has reiterated its overweight rating and cut its price target to £15. The sector has already felt the heat after broker Bernstein downgraded SEVERN TRENT and suggested investors take profits. The fears are that strengthening regulatory headwinds will make the environment even tougher. Citing regulator Ofwat's suggestion that companies' ability to pay dividends should be restricted to 5% of the equity regulatory capital value, Bernstein's comments had an immediate and negative effect on shares in SEVERN TRENT, which slid 2% as disappointed shareholders pored over the potential effects on their own dividend payouts. Due to post full-year results on Wednesday, Severn's underlying profits before interest and tax came in 4.4% higher in the 6 months to the end of September, driven by the acquisition of Dee Valley, operating cost control and lower infrastructure spend. There were exceptional gains of £8.3 million arising from a further pension increase exchange arrangement that had been agreed with the trustees of the SEVERN TRENT pension scheme. But on the positive news front, the company said it's now generating the equivalent of 38% of energy needs from renewables and is on track for 50% by 2020. Credit Suisse has reaffirmed its neutral rating on SEVERN TRENT and set its price target at £22.20. JP Morgan Cazenove has upgraded its investment rating from neutral to overweight, while Morgan Stanley has reiterated its equal weight rating but cut its price target from £23.60 a share to £21.30. Well, that's all we have time for. If you want to find out more about the companies reporting in the week ahead, go to the Markets and Insights section on fidelity.co.uk. Thanks for watching.